Hey guys, welcome back. In today's video, we are talking about short lending shares out, AMC up 263%, shorts losing, and many more in this video. Firstly, we're taking a look at this. Goldman is lending out all their 4.5 million AMC shares and shorting the stock at the same time for much larger position. They spoof the stock daily and they also sell shares cheaply in equity raises. They're posting bids every day. No fund is too big to fail, despite what many think. So when you take a look at AMC, something that we've talked about in the past before is Goldman Sachs taking up a position in AMC and has increased their stakes quite largely. Now, what we're also seeing is the fact that they are constantly spoofing AMC at the same time. Now, we've talked about this in the past with how certain institutions buy AMC for the sake of being able to lend those shares out, but at the same time is to also give them insurance because they understand what's to come. We've seen many short sellers who have bought into AMC. Some has completely got rid of their short positions and going long on AMC. Others are, trying to balance a position, while some, of course, are just hedging at the end of the day. But what we are seeing is how short sellers who were once only short selling AMC have started to buy into AMC. Now, again, like I said, there are multiple reasons, either to lend out their shares, to hedge their positions, or because they understand what's to come. But what we are seeing is the fact they've bought in. Now, despite what they're doing, despite the fact they are obviously trying to spoof AMC, they're trying to lend AMC, they're trying to suppress AMC, you have to understand that Goldman Sachs themselves are in an extremely risky situation where we've talked about their derivative positions are too big for them. They have over 100x leverage with their total assets and how big their derivative position is. So you know that they are on very, very risky ground. And so the very fact they're trying to do this is obviously showcasing what they're trying to prevent, why they're panicking. And that when we see that, we can obviously understand in terms of why they need to buy AMC, but also why they need to suppress it at the same time. Because all of these short sellers have a much bigger position in shorts than they do longs. So whilst they can hedge some of their positions, they are still going to lose out when AMC squeezes. And that's what they're trying to either fix, prevent, or whatever they're trying to do. Now, the thing about AMC is we've just talked about how the short sellers of AMC are not in a good position. And Goldman Sachs isn't the only firm. We'll talk about some others later on in this video. But when you take a look at where AMC is at, AMC is actually doing very, very well. A reminder of just how amazing AMC is doing going into 2025. Let's review AMC's stunning fourth quarter 2024 result. Note the free cash flow positive metric up 263%. And so we've already obviously looked at the Q4 and we talked about why it's extremely good for AMC. And again, I'm extremely confident in what they will do. And you can see some of the summary made by Biotech, which says, this is what short sellers are still trying to suppress. A company moving against their position on all financials. What we can see is total revenues are net loss reduced by almost half. Net cash for positive, loss per share decreasing, high adjusted EBITDA, free cash flow positive, diluted loss per share near break even. Again, there is so much more, and movie attendance is up overall, movie attendance is up domestically, internationally. And so, average screens decreased by 271, closing underperforming sites. And so this is what we are saying. Now, I want to highlight on some things right here. So we've just talked about how well AMC is doing, and what I've noticed is that there are some comments here and there, and it's not the large majority, but I want to clear it up, which is talked about AMC closing down underperforming sites, and you can see here 271, and people are trying to talk about that. But the problem you have to understand here was that this was a good closing because the movie attendance is still up. So despite the fact they were able to close down 271 screens, they were still able to get attendance. And that shows how efficient they are. That shows that what they've done is actually well. And that's why their total revenues are up. That's why their net loss was reduced by almost half, because they obviously are able to cut down the operational costs. They are obviously able to increase their revenues when they just focus on, how efficient they are being. And so that's what we have to understand. But like I said, when you compare the fundamentals of AMC and others, you know that they are not in a good position. You can see here, another short seller of AMC. Well, Ken Griffin's Citadel posted a 1.7% drop in February and further losses in March. Nothing to see here. So we've talked about this. Hedge funds, institutions are not in a good place right now. We've seen how Citadel are posted a 1.7% drop. They are closing their positions, but not only that, it's being highlighted that they are closing their highly leveraged positions. And this is the thing that we have always been focusing on, which is understanding that we have always known short sellers are extremely over leveraged. They're taking extremely risky bets. What has always been allowed was the fact that no one ever talked about this and actually penalized for them. No one gave them the consequences. But now it's finally happening. These highly leveraged positions, which were once unregulated, are finally being looked upon, and now they're being closed. And that's what's happening. And so this is obviously gonna elope into a massive thing where we've talked about how one position is closing, which is going to cause another position to close, and again their collateral's falling, and you can see it's amplifying the broader market sell-off. And this is why we've said that these positions can heighten systemic risk. And so this is what we talked about. Shorts are not in a good position. So whether you're looking at Goldman Sachs, whether you're looking at Citadel, who are all short sellers of AMC, they are not in a good position. They are extremely leveraged. They don't have the correct risk management. They're running out of collaterals. They're running out of liquidity and capital. But vice versa, when you take a look at AMC, you're seeing the complete total opposite, where AMC's cash, so their liquidity, is going up. AMC's fundamentals is going up. AMC's debts are going down. And so when you compare the two, I don't understand what people are talking about when they say that AMC is going to go bankrupt, that AMC is a doomed company. Another thing, you can see what they're doing. Off-exchange volume on GME is nearing 60% again today. And so when we see that these shorts are struggling, when we see that they are lacking the money, they're lacking the capital, they're unable to use their collaterals to short AMC, to short GME, we're seeing the off-exchange volume goes up. And off-exchange volume going up is really just a reflection of the struggles of shorts. And we've already highlighted some of the things that they're struggled. We just talked about everything at the start of the video, but it's also about understanding why they just can't beat us. So we talked about AMC's fundamentals, but when you take a look at GME, you can see GME holds $4.5 billion in cash. Divide that by all the existing shares outstanding of 446.8 million shares is $10.26 per share. Naked short sellers can't get GME under $10.26 per share. And so whilst this isn't the deciding factor, obviously, for what the price of a stock should be, it does highlight how strong of a position GME is at. So AMC is at a strong fundamental position. GME is also at a strong fundamental position. And again, you can see that's why they're obviously trying to suppress GME. That's why they're trying to spoof and suppress AMC. And this is what we have to understand. All of these people are worried about AMC, are worried about GME. But when you are just looking at the fundamentals, and this isn't talking about any biased opinions, this isn't talking about any, trust me, bro, kind of source. We're looking at the information that's there. We know how much money GME has, so we understand what they can do. We know that AMC is improving fundamentally. What we also know is that Goldman Sachs are over leveraged. They're spoofing AMC. These are all data in which you can see with your very own eyes. We know that Citadel is losing money because just like we're seeing here, a 1.7% drop. And so these are all things that are just showing that the difference between AMC, GME against the short sellers are really just night and day. And so this is what we want. This is what we need to understand. And when you go into even more about some of the other short sellers who, again, other institutions who own swaps of AMC and GME, you can see EY, re-elected as UBS auditor last year, said in its assessment on Monday that because of the effect of this weakness, it has concluded that UBS had not maintained effective internal control over financial reporting as of end 2024. Does this remind you of Credit Suisse in March of 2023? Now, we know that UBS has had an extremely rough year, especially because of what has happened with Credit Suisse. And we also talked about how UBS has inherited all of US's Credit Suisse positions, which includes the AMC and GME swaps, which they could have already had some in the past before. And so this is showing how another short seller is also failing, is also being impacted by these toxic swaps they hold of AMC and GME. And so again, when you compare the fundamentals, you understand the difference. But yeah, guys, thanks for watching. I'll catch you guys next time.